Did you know the most important price in today's global economy isn't oil or technology, but money itself? For over 30 years, interest rates have been going down, making things like mortgages cheaper and allowing governments to spend a lot. But now, things are changing. The interest rates on U.S. Treasury notes that last for 10 years are going up. This shows a new time of expensive money. In this video, we'll explain why this change is happening, what it means for the economy, and how it might affect your financial future. The most crucial price in the global economy isn't oil, computer chips, or even fast food. It's the cost of borrowing money. For over 30 years, this cost was falling. Now, it's rising. Look at the interest rate on 10-year U.S. Treasury bonds, which has shot up towards 5% recently. This increase affects mortgages and loans for businesses. Initially, it seemed linked to a strong jobs report, but as the bond market continued to struggle, another reason emerged. Investors are realizing something big has changed. Money will be expensive for a long time, partially because the Federal Reserve is still working on controlling inflation. Most people think central banks like the Federal Reserve control the cost of money, and they do set interest rates. But fundamentally, like anything else, the price of money reflects how much is available and how much people want to borrow. If people save more from their paychecks, the cost of borrowing goes down. If there's a lot of demand for borrowing, like when the government spends on infrastructure or businesses invest in new technology, the cost goes up. Economists call the balanced price of money that keeps inflation stable the natural rate of interest, or R star. Imagine if the Fed set borrowing costs much lower than this natural rate. Too much borrowing could cause inflation to rise sharply. On the other hand, setting borrowing costs too high could lead to too much saving and not enough investment, which could slow down the economy and increase unemployment. Understanding the natural rate of interest is tricky. As economist John Henry Williams noted almost a century ago, it's like faith. Its effects are what prove its existence. Central bankers face a challenge. If their policies stabilize prices, they've likely aligned interest rates with this natural rate. If not, they haven't. Today, this natural rate, known as R star, remains elusive. Federal Reserve Chair Jerome Powell has questioned its usefulness in guiding monetary policy. Some economists believe we're at a turning point. Lawrence Summers and Kenneth Rogoff argue that the era of low-cost borrowing is ending. They point to increased government spending on defense and the shift toward greener economies. However, not everyone agrees. Olivier Blanchard believes inflation will ease, but low interest rates will persist. He and others argue that factors like demographics and slow productivity growth, which pushed rates down before the pandemic, will return once inflation is under control. What caused interest rates to drop? Let's understand focusing on factors influencing savings and investment demand across a half-century and 12 major economies. The natural interest rate for a 10-year U.S. government bond adjusted for inflation dropped from 5% in 1980 to less than 2% in recent years, according to economists. One major reason for this decline was slower economic growth. In the 1960s and 70s, the U.S. economy grew nearly 4% annually, fueled by a growing workforce and rapid productivity gains. However, after the 2007-2008 financial crisis, average annual GDP growth slowed to around 2%, making long-term investments less attractive and pushing the natural interest rate lower. Demographic changes also played a role. Starting in the 1980s, as baby boomers saved more for retirement, the supply of savings increased, further reducing the natural interest rate. Other factors also pressured interest rates downwards. China began investing its trade surpluses in U.S. Treasury bonds, and income inequality in the U.S. grew, with higher earners saving more of their income. On the investment side, advancements in technologies made computers cheaper and more powerful, reducing the need for companies to spend heavily on upgrading technology and lowering the natural interest rate. These lower borrowing costs had significant impacts on the U.S. economy. Low mortgage rates allowed households to take on larger debts, contributing to the 2007-2008 financial crisis. Despite a nearly tripling of federal debt since 2000, the cost of servicing this debt remained manageable due to low interest rates, enabling continued government spending. However, for the Federal Reserve, lower natural interest rates meant less room to cut rates during economic downturns, limiting the effectiveness of monetary policy. Several factors that previously lowered the cost of borrowing are now reversing. Baby boomers are retiring and spending their savings, reducing the supply of available funds. Meanwhile, tensions between the US and China, along with changes in China's economy, have reduced their demand for US treasuries. US federal debt has surged due to the global financial crisis and the COVID-19 pandemic. Although stimulus spending has slowed, deficits remain large. Increased competition for investment capital, driven by federal incentives for electric vehicle and semiconductor manufacturing, is pushing up long-term borrowing costs. Economics predict the natural interest rate will rise by about 1 percentage point from a low of 1.7% in the mid-2010s to around 2.7% by the 2030s. This could mean 10-year Treasury yields settling between 4.5% and 5% in nominal terms. There's also a risk that borrowing costs could rise even higher than this baseline projection suggests. Governments are expected to eventually take steps to manage borrowing responsibly. However, with Democrats and Republicans struggling to agree on fiscal policies, there's a risk that U.S. deficits will remain large for the foreseeable future. Efforts to combat climate change have been modest, but substantial investments will be needed if global efforts intensify. Research estimates that transitioning to a zero-emissions economy will require over $30 trillion globally, about 30% of last world's GDP. Advances in technologies like artificial intelligence could also enhance productivity, potentially accelerating U.S. economic growth. Research forecasts that ongoing high government borrowing, increased climate spending, and faster economic growth could push the natural interest rate to 4%. This would likely translate to nominal yields of about 6% for 10-year bonds. Even in a less extreme scenario, the shift from declining to rising interest rates will profoundly impact the U.S. economy and the global financial system. Low-cost mortgages have significantly fueled the continuous rise in U.S. housing prices since the 1980s, leading to affordability challenges. The S&P 500 has seen substantial growth since the early 1980s, partially driven by low interest rates. However, as borrowing costs rise, this support for continually rising home and stock values will diminish. Higher rates could spark a period of creative destruction, according to economist Joseph Schumpeter, potentially leading to the collapse of many unprofitable companies. Nearly half of all publicly traded companies worldwide were unprofitable in 2022, highlighting a trend toward corporate inefficiency. Bankruptcies could redirect resources toward more productive uses. One of the most significant impacts of higher rates will likely be felt by the U.S. Department of the Treasury. Even if the national debt stabilizes relative to the economy's size, increased borrowing costs could add an additional 2% of GDP annually to debt payments by 2030. This would have amounted to an extra $550 billion paid to bondholders last year alone, more than 10 times the U.S. aid provided to Ukraine. However, not all effects of rising rates are negative. Federal Reserve Chair Jerome Powell has likened predicting the natural interest rate, R*, to navigating by stars, noting its unpredictable trajectory shifts. As these changes unfold, economic waters could become increasingly challenging to navigate.